Hello students, today we will study our topic macroeconomics, government budget and the economy. Government budget and the economy. Introduction. Every economy has to plan the welfare activities for their citizens. This planning comes under budget. A budget is a document containing detailed programs and policies of action for the given fiscal year. Now, what is fiscal year? A period of 12 months over which the accounts and taxes of a company or person are calculated. Now, meaning of government budget. A government budget is a document prepared by the government and or other political entity presenting its anticipated tax revenues and proposed spending or expenditure for the coming financial year. The government budget is an annual fiscal statement depicting the revenues and spending for a financial year that is often moved by the legislation sanctioned by the chief executive or president and given by the finance minister to the country. Budget is also known as the annual financial statement of the nation. Government budget forecast by a government of its expenditures and revenues for a specific period of time. In national finance, the period covered by a budget is usually a year known as a financial or fiscal year, which may or may not correspond within the calendar year. Fiscal year 1st April to 31st March. Okay, students. Now, next is important points of government budget. First, different levels of budget. Central, state, and local. They know their state demands and prepare budget according to that. Second, union budget. Union budget of India is the country's comprehensive annual financial statement. The union budget consists of a detailed account of the government's finances, its revenues and expenditures. Third, estimated receipts and expenditures. Government will plan their expenditure to keep the welfare point in mind how and which type of development they want to do. Fourth, day of presentation of budget. 1st February 2020 by Finance Minister. 5th, approval by the Parliament. Now the next is objectives of government budget. First, reallocation of resources. Through a budget, government endeavors to equally allocate resources and wealth. They encourage small industries like khadi to flourish by allowing subsidized loans and reduced taxes on raw material needed for production. Government can also levy hefty taxes upon production of harmful products like liquor, cigarettes to discourage production of those goods. Second, reducing inequalities in income and wealth. The government tries to bring economic equality of society. They do so by imposing taxes on the affluent classes of society and spending them for welfare of the economically weaker section of the community. Higher tax rates on a certain group of nationals and organizations can have a severe impact on the overall economy. Third, economic stability. Budget keenly focuses on lowering the prices fluctuations in the market. Policies like deficit budget during deflation and surplus budget during inflation thrive on bringing stability within the economy. Fourth, management of public enterprises. Several public sector industries are established for the social welfare of the public. An annual budget provides financial aid to such businesses to grow. This objective organically strengthens the economic structure of a nation. Fifth, economic growth. The overall economic growth of a nation relies on savings and investments. Budgetary policies are hence introduced to infuse enough resources in different public sectors. Government makes provision to boost the rate of savings and investments made within the economy. Sixth, reducing regional disparities. One of the chief aims of government budget is to alleviate social disproportion. They achieve so by installing manufacturing facilities in the economically weaker section of the society, also by producing goods and services directly to them. So these 6 points tells you about the objectives of government budget. First, reallocation of resources. Second, reducing inequalities in income and wealth. Third, economic stability. Fourth, management of public enterprises. Fifth, economic growth. Sixth, reducing regional disparities. Now, components of budget: revenue budget, capital budget. Revenue budget. It consists of revenue receipts of the Government of India and the expenditure met using that revenue. The revenue budget details the sources from where the revenue is coming to the government. The government sources of revenue are tax collected from people and corporations. The government also makes investments through various instruments and receives interest and dividends on those. Its non-tax revenues include the disinvestments that the government does in the companies where it holds stakes. This also accounts for the revenue for the government. Second, capital budget. Capital budget consists of capital receipts like disinvestment, borrowing, loans from public or foreign governments, RBI, etc., and capital expenditure like expenditure on development of machinery, health facilities, etc. Capital budgeting comprises two words, capital and budget. It implies setting target for projects or schemes to ensure maximum profitability. Now, budget receipts. It includes two types of receipts, revenue and capital. Revenue receipts include tax revenue and non-tax revenue, and capital receipts include borrowings, recovery of loans, other receipts. Budget receipts. A receipt budget is one of the most important documents in a union budget. It is an extensive list of income generated from the different sources by the government in a given financial year. It showcases the breakup of revenue generated under different heads. Part of the annual financial statement of the government, the receipt has details of tax revenue, non-tax revenue, and capital receipts. It also contains information and analysis of tax and non-tax receipts along with the fiscal trends of the year. Revenue receipts. Revenue receipts can be defined as those receipts which neither create any liability nor cause any reduction in the assets of the government. They are regular and recurring in nature, and the government receives them in the normal course of activities. Revenue receipts include the proceeds from taxes and other duties levied by the center, the interest and dividend it receives on its investments, and the fees and charges the government receives for its services. Simply put, revenue receipts must satisfy two basic conditions. No liability. Revenue receipts do not create any liability for the government. For example, taxes received by the government, unlike borrowings, do not create any liabilities for it. No asset reduction. Revenue receipts do not lead to any reduction in the government's asset. So, the government can't show its earnings from sale of stake in a public sector undertaking as revenue receipts because the stake sale resulted in reduction of its assets. For the government, there are two sources of revenue receipts, tax revenues and non-tax revenues. Tax revenue. Tax revenue forms part of the receipt budget, which in turn is a part of the annual financial statement of the union budget. Description. It gives a detailed report on revenue collected from different items like corporation tax, income tax, wealth tax, customs, union excise, like land revenue, stamp registration, etc. Taxes collected from both direct and indirect tax are considered in tax revenue. Direct taxes. Direct tax is a tax an individual or organization pays directly to the imposing entity. A taxpayer, for example, pays direct taxes to the government for different purposes, including real property tax, personal property tax, income tax, or taxes on assets. Indirect taxes. An indirect tax is collected by the one entity in the supply chain, usually a producer or retailer, and paid to the government, but it is passed on to the consumer as part of the purchase price of a good or service. The consumer is ultimately paying the tax by paying more for the product. Non-tax revenue. Non-tax revenue is the recurring income earned by the government from sources other than taxes. The most important receipts under this head are interest receipts received on loans given by the governments to states, railways, and others, and dividends and profits received from public sector companies. Various services provided by the government, police and defense, social and community services such as medical services, and economic services such as power and railways also yield revenue for the government. Though the railways are a separate department, all their receipts and expenditure are routed through the consolidated fund. Now, capital receipts. Capital receipts are receipts that create liabilities or reduce financial assets. They also refer to incoming cash flows. Capital receipts can be both non-debt and debt receipts. Loans from the general public, foreign governments, and RBI form a crucial part of capital receipts. Capital receipts are loans taken by the government from the public, borrowings from foreign countries and institutes, and borrowing from the RBI. Recovery of loans given by the center to states and others is also included in capital receipts. In the balance sheet, capital receipts are mentioned in the liabilities section. The capital receipt has the nature of non-recurrence. All capital receipts are tax-free unless there is a provision to tax it. Capital receipts can be both non-debt and debt. They create liability like loans. They cause reduction in assets. Government will send their shares to get money. Now, sources of non-tax revenue. First, interest. Interest that are received by the government through the loans provided by it to the state governments, UTs, private enterprises, and the general public are an important source of non-tax revenue. Second, power supply fees. This include fees received by the Central Power Authority of any nation. In the case of India, this includes fees received by the Central Electrical Authority. Third, fees. They are the charges that cover the cost of recurring services that are provided and imposed by the government. It is a compulsory contribution like a tax, like court fees, import fees, etc. License fee. It is a form of tax charged by the government and its aligned entities for conducting an activity that can be anything such as opening a restaurant or operating a heavy vehicle. Fines and penalties. Fines are mostly used in the context of criminal law, wherein a court of law will punish a person convicted of a crime by imposing a fine. Penalty, meanwhile, is used in both civil as well as criminal law. It includes monetary and physical forms of punishment. Escheats. Escheats is a transfer of estate assets or property to the government if an individual passes away without leaving a legal binding bill or legal heir. The government makes revenue out of it. Grants. Several grants are received by the government from the various international organizations and foreign governments. Such grants are not a fixed source of revenue and are generally received during a national crisis such as war, flood, etc. Forfeitures. These are the form of penalties which are imposed by the courts for non-compliance of orders or non-fulfillment of contracts, etc. So these are the 8 sources of non-tax revenue: interest, power supply fees, license fee, fines and penalties, estates, grants, and forfeitures. Now next is sources of capital receipts. First, borrowing, domestic and international. Funds raised by government from borrowing are treated as capital receipts. These funds are borrowed from open market, known as market borrowing, RBI, foreign governments and international organizations like World Bank, Asian Development Bank, etc. Government resorts to borrowing when its expenditure exceeds its revenue. Second, recovery of loans. Loans offered by government to others are government assets because it owns money that it lends. We know that central government grants loans to states, union territories, public sector enterprises, other parties, foreign governments. Recovery of all such loans is treated as capital receipts because it causes reduction in assets of government. Third, disinvestment. Government raises funds from disinvestment also. Disinvestment means selling whole or part of the shares, that is equity, of selected public enterprises held by the government to private sector. As a result, government assets are reduced. Sometimes disinvestment is also termed as privatization because it involves transfer of ownership of public sector enterprises to private entrepreneurs. So these 3 points are the sources of capital receipts: borrowing domestically and internationally, second, recovery of loans, third, disinvestment. Now, budget expenditure. Expenditure budget provides complete information about the total expenditure of the union government in a financial year. This exhaustive information is classified into two broad categories as per the end use: capital expenditure and revenue expenditure. While the former results in the creation of a physical asset or investment, the latter comprises mainly operational expenses such as payment of wages, pensions, subsidies, and interest. First, revenue expenditure. It is that part of government expenditure that does not result in creation of asset. Payment of salaries, wages, pensions, subsidies, and interest fall in this category as revenue expenditure examples. Also note that revenue expenses are incurred by the government for its operational needs. High revenue expenditure means that the government machinery is spending too much money on sustaining itself rather than creating assets required to achieve high economic growth. Second, capital expenditure. The union government defines capital expenditure as the money spent on the acquisition of assets like land, buildings, machinery, equipment, as well as investment in shares. Capital expenditure is the part of the government spending that goes into the creation of assets like schools, colleges, hospitals, roads, bridges, dams, railway lines, airports, and seaports. Capital expenditure also covers the acquisition of equipment and machinery by the government, including those for defense purposes. Capital expenditure also includes investment by the government that yields profits or dividend in future. High capital expenditure usually means more investment by the government towards the creation of infrastructure and other assets that are crucial for rapid economic growth. Now, measures of government deficit, budgetary deficit. There are three measures of government deficit. First is revenue deficit, second is fiscal deficit, and the third is primary deficit. Now, in the upcoming slides, we will read these three types of budgetary deficit. Okay, students? First, revenue deficit. Revenue expenditure minus revenue receipts. It signifies that government's own revenue is insufficient to meet the expenditures on normal functioning of government departments and provisions for various services. This revenue deficit mentions to the surplus of government's revenue expenditure over the revenue receipts. This deficit only incorporates current income and current expenses. A high degree of deficit symbolizes that the government should reduce its expenditures. The government may raise its revenue receipts by raising income tax. Disinvestment is selling off assets is another corrective measure to minimize revenue deficit. Formula क्या है? Revenue expenditure minus revenue receipts. Now, measures to reduce revenue deficit. First, reduce expenditure. Second, increase revenue. Reduce expenditure. Government will reduce expenditures on unnecessary purposes. Second, increase revenue. Government will increase tax rates so they will get more revenue. So these two measures to reduce revenue deficit. First, reduce expenditure. Second, increases revenue. Next, fiscal deficit. Total expenditure minus total receipts excluding borrowing. The extent of fiscal deficit is an indication of how far the government is spending beyond its means. The fiscal deficit has to be financed by borrowing. Hence, it manifests the total borrowing necessities of the government from all possible sources. Formula of fiscal deficit is total expenditure minus total receipts excluding borrowings. Now the next is implications of fiscal deficit. First, debt trap. Fiscal deficit, that is borrowing, creates problems of not only a repayment of loans but also of payment and interest. As the government borrowings increases, its liabilities in future to repay loans along with interest thereon also increases. Payment of interest increases revenue expenditure, leading to a higher revenue deficit. Increased revenue deficit may further lead to more borrowing and more interest payment. Ultimately, government may be compelled to borrow to finance even interest payment, leading to emergence of a vicious circle and debt trap. Second, wasteful expenditure. High fiscal deficit generally leads to wasteful and unnecessary expenditure by the government. Therefore, fiscal year should be kept as low as possible. Third, inflationary pressure. As government borrows money mainly from the RBI, which meets this demand of more currency notes, it results in circulation of more money. This may cause inflationary pressure in the economy. Fourth, retards future growth. The entire amount of fiscal deficit, that is whole borrowed amount, is not available for growth and development of economy because a part of it is used for interest payment. Only primary deficit is available for financing expenditure. In fact, borrowing is financial burden on future generation to pay loan and interest amount which retards growth of economy. Fifth, increases foreign dependence. Government also borrows from foreign countries. This increases dependence on foreign countries, which often lead to economic and political interference. Next, sources of financing fiscal deficit. There are two sources of financing fiscal deficit. First, borrowing. Borrowing from internal and external sources. Second, deficit financing. Printing of new currency. RBI issues new currency. So these two are the sources of financing fiscal deficit. First is borrowing. Second is deficit financing. Primary deficit. Fiscal deficit minus interest payments. A primary deficit is the amount of money that the government requires to borrow apart from the interest payments on the formerly borrowed loans. We must make a note that the borrowing necessity of the government comprises interest responsibilities on the collected amount of debt. The aim of quantifying the primary deficit is to concentrate on current fiscal imbalances to attain an approximate of borrowing on account of current expenditures overreaching revenues. We need to compute which has been known as the primary deficit. It is the fiscal deficit minus interest payment. So these three budgetary deficits are important from examination point of view. That is fiscal deficit, revenue deficit and primary deficit. Now, plan and non-plan expenditure. Plan expenditure, that is incurred on the programs detailed in the current 5-year plan. Example, expenditure on agriculture and aligned activities, irrigation, energy, etc. Plan expenditure include which are already planned in the budget. Non-planned expenditure, expenditure other than the expenditure related to the current 5-year plan. These are not planned. Example, payment of interest, expenditure on defense services, etc. Is developmental and non-developmental expenditure. Developmental refers to the expenditure which is directly related to economic and social development of the country. Example, education, health, etc. Non-developmental expenditure, expenditure which is incurred on the essential general services of the government, example defense, police, etc.